Hi, Steve Jader with TCT Property Management Services, and we are the resource for people building financial security, financial independence, building wealth with real estate. And today, what I want to talk about is the single-family home retirement strategy. Single-family homes and retirement strategy. So how can we retire owning single-family homes? Well, the first thing that we need to do is you need to determine how much money do I need to actually be able to retire. So I'm going to make some assumptions here, and you can see them up here on the screen. The first one is that we're going to have inflation, and inflation is going to be 3%, and it's going to average 3%. And we're going to assume that I'm now making $5,000 a month, and I want to retain that lifestyle that I have with the $5,000 a month, and that I'm going to actually retire in 30 years. So the first thing I want you to do is I want you to take your phone, turn the calculator on, and then turn it to the landscape position. And your calculator should shift, okay? And you should see a different calculator on it, okay? So what I want you to do, having done that then, is I want you to take 1.03, that's our 3% inflation, and you're going to hit a key that's y over x. Look for the key that says, on your calculator, that says y over x, and then push the number 30. And when you do that, you should see 2.42. That's the formula for 3% inflation for 30 years. Now what we're going to do is we're going to say, okay, now we multiply that times our current income. That's what we want to maintain that lifestyle, and it's $5,000 a month. So 2.42 times the 5,000 equals a little over 12,000. That's how much money you're going to need to have per month in 30 years based on inflation in order to just maintain your lifestyle. So if we take that $12,000 a month, that means you need to be making $145,000 a year. Well, if you talk to a financial planner and a financial advisor, they tell you that when you take your money and you put it into your retirement accounts and you put it into your investment accounts, that if you withdraw it at 4% per year, you can maintain that money that you have there. It's called the 4% rule, and it's the safe way to maintain that money. So when you do that and you take $145,000 divided by 0.04 or 4%, that means you need to save $3.6 million in order to maintain your lifestyle over the next 30 years. I don't know if that's shocking to you, but it is to me. Okay, so here's a couple of thoughts. Can I save my way to financial security? Can I just put it in the bank? Well, $3.6 million over 30 years is saving $120,000 a year. Do you have an extra $10,000 a month to put away? Here's another thought I want to share with you. Cash is not an asset. Cash is the tool that you use to buy assets, but cash is not an asset. Cash actually loses value because the inflation rate makes it worth less every year. But most people think, oh, I got my cash in the bank and I'm good because I got money in the bank. No, if you've got that money and it's just sitting in cash, it's getting worth less instead of buying an asset that makes more. And then here's the next thought. If you do own an asset, what's your return on investment? I was talking to a guy the other day who had money in his IRA, and he goes, and I said, so what's your return? I don't know, it went up, he says. Well, went up how much? A lot, a little? What's your return on investment? And then finally, what we just did was, how much cash flow do you need? How much do you want? Do you have big dreams for what retirement looks like? Or you just want to maintain? So you can use the formula that we just shared in order to determine that. So how do I get there? Well, the traditional way is put your money into mutual funds. You hear guys on the radio talking about that. So I'm going to make 5 assumptions in putting your money into mutual funds. Number 1 is we need $3.6 million. That's our target. Number 2 is when you buy a mutual fund, you pay $1 for $1's worth of the fund. Okay? Or when you buy a stock, you pay $1 for every $1's worth of the stock. The third assumption we're going to make is that you're going to start with $75,000, and we'll talk more about that in a minute, okay? And that you're currently saving $2,000 a month. Now, don't get scared about the numbers. If you only have $10,000 and you can only save $500 a month, just the numbers shift. That's all there is to it, okay? And then here's the 5th assumption, and that is that you're getting a 10% return on your savings. Now that's aggressive, okay? But we're going to use those as our assumptions here, okay? So when we use a mutual fund, the target's 3.6. We put it at 75,000 is what we started with. We're going to get a 10% rate of return, and every month we're going to contribute an additional $2,000. Well, if you take a look over here, it's going to take you 26 years to get there. 26 years of saving that money to get there. All right? Nothing wrong with that. 26 years to hit your goal. But here's the other thing. You put $622,000 of your money in, and the rest came from the 10% return on investment that you're getting. Okay? Now, let's do it differently, and let's say, how do you get there? But let's play Monopoly. Now, everybody's played Monopoly as a kid. Have you played it for real? Okay? Let's play Monopoly for real. We're going to start with the same $75,000. We're going to buy one house for $300,000. That house we'll put $60,000 down. That's 20% down payment. And we're going to get a 4% interest rate on the loan. Now, you can do better than that as I'm making this video, but we'll assume a 4%. And based on the current rent rates, the current interest rates, all of this, you should have about a $250 per month positive cash flow. That's $3,000 per year. And what we're going to do is we're going to take that and we're going to add it to the principal balance. We're going to let the tenant pay our loan down for us even faster than 30 years. So the loan is now going to pay off in 20 years. So, and our final assumption is that the property is going to appreciate at 4% per year. Now, I wrote a book called Hold. It was a national bestseller, and I was a co-author in that book. And we went back and we did the research, and we went back 40 years, and over that 40-year period of time, the average appreciation for real estate was 4%. There's years it went up, years it went down, but it was a 4% average rate. By the way, in the Phoenix area, over the last 20 years, it's been 4.5% per year average every year. So that's why we're using 4%. Okay? So what happens? Well, 20 years from now, the house is paid off. It's worth about $540,000, not $300,000. You don't have a loan anymore, and the rents have gone up along with the inflation rate. So you're now receiving $3,500 a month. Remember, we said you needed $12,000, so we're partway there. You're now receiving $2,500 or $3,500 per month. So then what do? We keep playing Monopoly for real. We started with $75,000. We invested $60,000 of our $75,000. So we still have $15,000 left, and we're continuing to save $2,000 per month for the next 2 years. And so all of a sudden, in year number 3, we have $64,000 saved. So let's buy another one. Let's go out and do it again. Now, how do we know it pays off? Well, this is just a quick calculation. I'm going to leave it up on the screen just for a minute. But you can see that the $240,000 loan that we took out at the beginning, because we added our positive cash flow back to the loan, it pays off in 21 years. So we use that positive cash flow to pay it down. Well, what happens if we increase it by just another $75 over the period of time because the rents have gone up? Well, we get free and clear in 16.6 years. In other words, the faster we can accelerate using the tenant's money, the quicker we get to free and clear. All right, now here's our goal. We repeat this 4 times. What winds up happening? We create $14,000 a month in passive income. How much did we need? We needed 12. So we're actually better because we repeated it 4 times. And because we did this, we contributed $60,000 4 times. That's $240,000. It was our total contribution over a 6 to 9 year period of time. If it takes you 12, if it takes you 15, it's okay. This is just our example. Well, remember how much we put into the mutual fund example? We put in $622,000 of our money in order to be able to get $12,000 a month. In this example, I only put in $240,000, not $622,000. What am I going to do with the extra $400,000? Interesting question. And I'm actually getting more money. So where do I get this $75,000 even? And well, first of all, just start with what you have. Okay? And if you don't have enough right now, what would happen if you split ownership with a friend or a family member? You're still going to get there. You're just not going to get there as fast, but you're still going to get there. Okay? Number two, what if you rented out the house that you're living in and you bought another one with a down payment you can't afford? So if you only have 10 or 15,000 or 20, whatever it is saved, you actually say, okay, I'm going to rent this one out and I'll go buy something else. Okay? Use a self-directed IRA to buy number one and save up to buy number two. And talk with your CPA, because it may be possible, some people will be able to qualify for this, to actually take it out of your IRA and use cost segregation and depreciation. I'm not going to go into those here. I'm just throwing out ideas. Use cost segregation and depreciation to actually offset the penalty and the tax. So this is about getting in the game. What's the game? Monopoly. Monopoly for real. And you just keep playing, okay? But, people say real estate takes too much work. And, my financial advisor told me that stocks will give a strong return. You just have to hold on to it long period. Don't buy and sell. And a well-managed mutual fund performs better than real estate. I was told these things. And so what I did was I went and said, well, are these things true? Is this actually true? So first of all, real estate's too much work? Well, of course it is if you manage the property yourself. But if you hire a property manager and you include all of the stuff in your budget, it's not. You're probably going to get higher rent, probably going to get a better tenant. And hiring a property manager to manage your real estate is no different than hiring a financial advisor to manage your stock portfolio. You're just hiring a professional to do it better for you. Well, let's look at the stock market. What I did was I went back 20 years and I said, let's just look at the Dow Jones Industrial Average as our measure of what happened in the stock market. And you can see here in year 2000, it lost 6%, 2001, 7%, 2002, 17, then came back 23%. It was going up and down. All of the red ones are when it went down, all the green ones are when it went up. And so over that 20, if we look all the way down here, the 20-year average return is 5.82%. Now in our example, I assumed you're making 10%, that you're doing almost double the average. But over the last 20 years, that's the average return for the Dow Jones Industrial Average. You're told that if you hold on, you're going to make 8 to 10% return. Well, if you look at the last 2 decades, that's not true. The average really is about 6% is what you can expect out of the stock market, okay? Well, what if I get a 6% return? It's not 10%, but 6 isn't bad. The ROI makes a huge difference. You see, instead of taking 26 years to get there, it's going to take you an extra decade. It's going to take 36 years just because of the difference between 6 and 10%. So, but let's say we did this and we played Monopoly instead. So here's what we did, right? If I put the money in the stock market, I would have to put in $1 for each dollar of stock, 200,000. Here's what happened over this period of time, and you can see the value of my investment went down for a couple of years and then came back and then came back. It takes until year 20 for the stock market to beat this example. Now look at this one. This is real estate on the other side. Remember I told you real estate went up at 4% per year on average? Let's just say it only goes up 3.5%. And what I'm going to do is I'm going to buy one property for $200,000, and I only have to put down 20%. That's $40,000 for a down payment. Here's the value of my property going up 3.5%. Here's the money that the tenant is paying and putting into equity into my pocket. And so my investment value, my appreciation of the property, and the payoff of the mortgage is $210,000. So in year number 1, I'm $23,000 more money than the stock market, and then it continues to go on through. Here's my point. My point is, I only put $40,000 into one property. I had to put $200,000 into the stock market. And when I put that 200 in and I just go with what the averages are, I'm behind the 8 ball until year number 20. And I still have the rest of my money to buy additional ones. What do you suppose would happen there? We wrote a book on this. The book is called Hold, and I would recommend that you read 2 books. Number 1 is called The Millionaire Real Estate Investor. I'm a contributor to that book and a co-author in the book Hold. It's the safe and secure strategy. And at TCT Property Management, that's what we promote. And we help investors with the education. We help investors with the information. Should I buy this one or this one? Should I buy in this part of town or this part of town? And then we help them with the services that they need, so they don't have to be messing with it, taking care of it. They can just play the game Monopoly and have the safe and secure way to build wealth. So I want to invite you to see all of our videos on our YouTube channel and investor insights on all kinds of strategies and ideas for building wealth with real estate. Thanks for taking the time to watch this video. I realize this one's a little bit longer, but it's really, really important that you know the truth.